A simple way to think about valuing a deal is to compare two ways of paying for a house. You can hand over cash today, or you can give the seller a piece of a new partnership that will own the house. In an M&A context, cash consideration means the buyer pays a set dollar amount per share or a lump sum, and the seller receives money immediately. Stock consideration means the buyer issues its own shares to the seller, so the seller becomes a part owner of the combined company. The valuation framework asks two questions. First, what is the fair market value of the target? Second, how does each payment method translate that fair market value into a price? For cash, the price is usually expressed as a cash per share premium over the target's recent trading price. Example, target trades $30, buyer offers $40 cash per share, $10 premium, 33% premium on price. For stock, the price is expressed as an exchange ratio, how many buyer shares are given for each target share. The value of the offer equals the exchange ratio multiplied by the buyer's current share price. Example, buyer's share price $50, exchange ratio 0.8, target receives $40 per share, 0.8 times $50. The framework also compares the total enterprise value implied by each method, adjusts for debt assumed, and checks whether the combined entity's post-deal value justifies the price. In practice, analysts run a side-by-side discounted cash flow, comparable company, and precedent transaction analysis for the target, then overlay the cash versus stock price to see which is more attractive for shareholders and for the buyer's balance sheet. Earnings per share, EPS, accretion or dilution, tells you whether the combined company will earn more or less per share after the deal. Think of it like mixing two bowls of soup. You want the final bowl to be richer, more earnings per spoon than the original. The pro forma EPS is calculated after adjusting for the new number of shares and any extra earnings or costs associated with the transaction. The basic formula is pro forma net income equals buyer's net income plus target's net income minus net of any synergies plus transaction-related expenses. For example, integration costs, interest on new debt. Pro forma shares outstanding equals buyer's shares plus target shares times exchange ratio for a stock deal, or buyer's shares plus any new shares issued to fund cash, for example debt to equity financing. Pro forma EPS equals pro forma net income divided by pro forma shares outstanding. If pro forma EPS is greater than buyer's pre-deal EPS, the deal is accretive. If lower, it is dilutive. For cash deals, the key impact is the interest expense on the debt used to pay cash, which reduces net income but does not increase shares, so dilution can occur if interest is high. For stock deals, the buyer's EPS may be diluted simply because more shares now exist, even though net income rises by adding the target's earnings. Analysts often run a sensitivity table varying the exchange ratio, debt cost, and expected synergies to see at what point the deal flips from dilution to accretion. Taxes are like the rules of a board game. They change the way cash and stock moves affect each player's score. Buyer perspective. Cash deal, the buyer usually funds cash with debt or cash on hand. Interest on new debt is tax deductible, lowering taxable income, a tax shield. However, the cash outflow itself is not tax deductible. The buyer also must consider any purchase price allocation, PPA, the allocation of the purchase price to identifiable assets and goodwill, which determines future depreciation and amortization deductions. Stock deal, the buyer issues new shares, which has no immediate tax impact because no cash is paid. The buyer does not receive an interest shield, but the PPA still applies. If the buyer's shares are considered non-taxable for the seller, the transaction may avoid tax at the moment of the deal. Seller perspective. Cash sale, the seller receives cash, which is usually a taxable event. If the sale price exceeds the seller's tax basis in the shares, the excess is a capital gain, short or long term depending on holding period. Cash provides liquidity but triggers immediate tax liability. Stock swap, if the seller receives the buyer's stock in exchange for its own shares, many jurisdictions allow a tax-free reorganization, for example, U.S. Internal Revenue Code Section 368. The seller's basis in the new shares carries over from the basis in the old shares, postponing tax until those new shares are later sold. This tax deferral can be valuable, especially if the seller expects the buyer's stock to appreciate. Overall, cash deals tend to create immediate tax cash flow considerations for both sides, while stock swaps often provide tax deferral benefits for sellers and avoid interest-related tax shields for buyers. Financing a deal is similar to deciding whether to pay for a new car with a loan or by swapping your old car for a newer model. The choice influences the cost of capital and the risk profile of the buyer. Cash deal financing. The buyer may raise cash by issuing bonds or taking bank loans. The cost of debt after tax is the interest rate times 1 minus tax rate. Debt increases leverage, raising the weighted average cost of capital if the added risk outweighs the tax shield. Higher leverage also subjects the combined firm to covenant constraints and higher bankruptcy risk. If the buyer uses existing cash reserves, there is no new financing cost, but shareholders lose cash that could have been returned as dividends or used for other investments. Stock deal financing. The buyer creates new shares to give to the seller. This dilutes existing shareholders but does not add debt, keeping the weighted average cost of capital lower if the buyer's cost of equity is lower than the cost of debt after tax. However, stock issuance can increase the equity risk premium because the firm's equity base becomes larger and the market may view dilution negatively. Often, a buyer uses a mix of cash and stock, called a cash-stock split. The financing mix is chosen to balance the desire to limit dilution with the need to keep leverage at a comfortable level. The cost of capital implication can be captured by recalculating the post-deal weighted average cost of capital. WACC equals E over V times RE plus D over V times RD times 1 minus TC. Here, E is the market value of equity including new shares. D is debt raised, V is E plus D. RE is cost of equity, RD is pre-tax cost of debt, and TC is corporate tax rate. A cash-heavy deal raises D. A stock-heavy deal raises E. The optimal mix minimizes WACC while satisfying strategic and market constraints. Accounting is the language that tells investors what really happened after the deal. The rules differ slightly under US GAAP and IFRS, but the core ideas are similar. Cash deal accounting purchase method. The buyer records the acquisition at fair value of the consideration transferred, cash paid plus assumed liabilities. This amount becomes the purchase price. The buyer then performs a purchase price allocation, PPA. Identifiable assets and liabilities of the target are measured at fair value, and any excess is recorded as goodwill. Goodwill is not amortized. It is tested annually for impairment. If the fair value of the reporting unit falls below its carrying amount, an impairment loss is recorded. The target's prior equity disappears. The buyer consolidates the target's assets, liabilities, and results of operations into its own financial statements. Stock deal accounting, equity method for the transaction. Even though the buyer issues shares, the consideration transferred is still measured at fair value, the market value of the shares issued at the transaction date. The same PPA process follows, and goodwill is recognized in the same way. The main accounting difference is equity dilution. The buyer adds the new shares issued to its shareholders' equity, common stock, additional paid-in capital. The consolidated balance sheet reflects a larger equity base. Under IFRS, a stock acquisition may qualify as a business combination and is accounted for similarly. However, IFRS 3 allows more flexibility in measuring contingent consideration. Consolidation effects. Both cash and stock deals result in full consolidation of the target, unless a partial acquisition, which may trigger significant influence accounting. The consolidated income statement combines both companies' revenues and expenses, affecting EPS as discussed earlier. The key difference for analysts is the impact on leverage, cash adds debt, stock adds equity, and on dilution, stock adds shares. These differences flow through ratios like debt to equity, ROE, and market cap calculations. Every M&A deal needs the green light from several groups, much like getting permission to build a new road. You need the landowner's consent, city approval, and sometimes a federal permit. Shareholder approval. Buyer. If the deal involves issuing a large amount of new shares, the buyer's charter may require a shareholder vote, for example exceeding a certain dilution threshold. Proxy statements are filed, and shareholders decide whether the proposed exchange ratio is fair. Target. Usually the target's shareholders must approve the offer. The board may recommend acceptance, but the ultimate vote is on the price in form of consideration, cash versus stock. In a cash-only offer, shareholders get immediate value. In a stock-only offer, they become part owners of the combined firm. Regulatory constraints. Securities laws. Both parties must file Form S-4 or similar with the SEC in the United States, disclosing the deal terms, financial statements, and risk factors. Stock exchange rules. Exchanges may require timely disclosures, minimum float requirements, and may block a deal if the post-transaction float falls below thresholds. Antitrust competition review. In many jurisdictions, United States Department of Justice, Federal Trade Commission, European Union Commission, large mergers must be notified and cleared under competition law. The review examines whether the combined entity would have excessive market power. The horizontal merger guidelines assess market concentration using the Herfindahl-Hirschman Index. HHI. If the post-merger HHI rises substantially, authorities may require divestitures. Stock deals can raise extra scrutiny if the buyer gains a controlling stake without cash, because the buyer can acquire the target more cheaply, potentially making the merger appear less competitive. Failure to secure any of these approvals can stall or terminate the transaction, regardless of the financial attractiveness of cash versus stock. Step 1. Compute offer price per B share. Offer price equals exchange ratio times price of a share, equals 0.9 times $60, equals $54 per B share. Step 2. Total consideration. Total consideration equals $54 times 5 million B shares, equals $270 million. Step 3. New shares issued by A. New shares issued equals exchange ratio times B shares outstanding, equals 0.9 times 5 million, equals 4.5 million A shares. Step 4. Post-deal ownership percentages. Pre-deal A shares equal 10 million. After issue, total A shares equal 10 million plus 4.5 million, equals 14.5 million. Former B shareholders now own 4.5 million divided by 14.5 million, equals 31.03% of the combined company. Existing A shareholders retain 68.97%. Step 5. Implied equity value of combined firm. Combined equity equals post-deal A shares times a share price, equals 14.5 million times $60, equals $870 million. Assuming the market continues to price A's shares at $60, in reality the price may adjust. Step 6. Dilution check EPS. Assume A's net income equals $80 million, B's net income equals $20 million. Pro forma net income equals $100 million. Pro forma shares equal 14.5 million. Pro forma EPS equals $100 million divided by 14.5 million, equals $6.90. A's pre-deal EPS equals $80 million divided by 10 million, equals $8. Because $6.90 is less than $8, the deal is EPS dilutive. This example illustrates how to translate an exchange ratio into an offer price, compute the number of new shares, and derive the ownership split and EPS impact. Decision tree question: Company X is evaluating a $500 million acquisition of Company Y. It can pay either a cash finance with 70% debt at 5% after-tax interest, or B, stock by issuing enough shares to give Y's shareholders 25% ownership. Y's net income is $40 million, X's net income is $200 million, and X trades at $80 per share with 5 million shares outstanding. Calculate the post-deal earnings per share under both alternatives and decide which is accretive. Show all steps. Tax impact scenario: assume the target's shareholders have a basis of $15 per share and the cash offer is $45 per share. What is the capital gain tax for a 20% rate? If instead the deal is a stock swap with an exchange ratio that values the target at $45 per share, what is the tax deferral rule under United States Internal Revenue Code 368? Explain the advantage for the seller. Regulatory constraint question: a proposed merger would increase the market HHI from 1,800 to 2,500 in a market with 3 players. According to the United States horizontal merger guidelines, is this a significant increase? What remedies might the agencies require? Financing cost comparison: derive the post-deal weighted average cost of capital for the cash-financed option. Assume pre-deal capital structure: 40% equity, 60% debt, cost of equity 10%, pre-tax cost of debt 6%. Then compute weighted average cost of capital for the stock-only option, same cost of equity. Which structure yields a lower weighted average cost of capital? Accounting treatment question: explain how goodwill would be measured under generally accepted accounting principles for the cash deal versus the stock deal. If the combined firm later discovers the fair value of an acquired intangible is $5 million less than recorded, what journal entry is required under each accounting standard? These questions test a student's ability to perform pro forma earnings per share calculations. Roman 2 evaluate tax consequences. Roman 3 assess antitrust thresholds. Roman 4 compute weighted average cost of capital under different financing mixes. And V apply purchase price allocation and impairment rules. A good answer will include